Dimming prospects in Indonesia's major markets, falling commodity prices and a surge in inflation are cutting into growth hopes for Southeast Asia's biggest economy and tempering enthusiasm for what has been a darling of emerging market investors. Joining me down the line to discuss his outlook is Gundy Cahyadi, economist with OCBC Bank. Gundy, the factors I mentioned are causing a degree of wariness among investors, but Indonesia continues to grow about 6% a year. This is still a healthy figure, so there obviously are aspects of Indonesia's economy which are performing well. Do you agree?
Yeah, right. I mean, I guess if we were to look at the domestic economy in Indonesia, it is still driven by a growing middle income class. And private consumption growth is likely to stay very strong, 5 to 5.5% growth this year, and that is likely going to, stay persistent until the year end. Even though we have had some negative sentiment in terms of the markets regarding Indonesia's prospect going forward, but by far and large, that segment of the economy is going to continue to be the main factor that will boost overall economic growth for the year. So 6% growth is still within reach despite all the negative things that we have been hearing about the economy in recent time.
Indeed, unlike most of its Asian counterparts, Indonesia has a strong domestic economy. But is it robust enough to cope with the likes of a slowing Chinese economy and also the unwinding of stimulus from the US Fed?
Right. I think on this front, the main risk that will be something that we should monitor about Indonesia will be the risk that will come from the financial markets. The risk stemming from a slowing Chinese economy and the unwinding of stimulus from the Fed that could trigger potentially more capital outflows from the region. Indonesia is vulnerable to further capital outflows because of the fact that their FX reserve cover is probably the lowest in the region. So there is some risk, especially if the rupiah were to weaken further. That will be something that will be a key drag to both investment growth and private consumption growth in the economy. So while the domestic economy, the underlying demand remains to be quite robust, but I will say that there are still substantial risks stemming from those two factors that you have mentioned.
In June, the BI hiked the benchmark interest rate, and in July it raised the rate twice as much as expected. The action was criticised by many given the Muslim fasting was due to commence, which affects prices anyway. What did you make of these decisions, and what are your expectations for the next rate meeting on August the 15th?
I think those are actually the right moves that the central bank has done. I think at that moment in time, what they were facing, like I mentioned, I think there's a lot of pressure on the rupiah to weaken, and obviously they knew that that's not something that they can afford because of the negative impact it will have on the economy and the impact that it will have on inflation. So I think the moves done by the BI by hiking the benchmark interest rate, that was a clear signal that they are willing to be ahead of the curve. There was also a clear signal that they are willing to step in to, provide some support to the rupiah, if anything, just by the signaling effect from those two rate hikes. So I think those moves, despite the some criticism that they have received, those two moves are really great from the central bank's perspective. Now, with regards to the expectation for the next rate meeting, I think they'll be a little bit more careful right now because as it is, they have done quite a little bit of tightening in terms of the benchmark interest rate, and of course, further in interest rate hike may not bode well for the economy, just as we've seen some signs that credit growth is also moderating. So we think that probably BI will stand pat on August the 15th.
A widening current account deficit and investment growth clearly under pressure, coupled with the aforementioned weak rupiah sentiment in the market, has weighed on imports of capital goods in recent months. But what is your outlook for the rupiah moving forward?
Yeah, we think that the rupiah may continue to be under pressure in the market because the main reason that has been weighing on the currency is the current account position of Indonesia. Indonesia is experiencing a current account deficit that is likely to be more structural than we earlier thought this year. So it's hard to get, the June correction in the market has has led to the equity market becoming attractive again, has led to the bond market becoming attractive again. But the underlying factor for the rupiah, its current account deficit position, is likely to persist, and we think that's going to be the key reason why the rupiah will continue to be under pressure up until next year. So we are looking probably at dollar rupiah staying in the 10,200, 10,500 till next year.
Gundy, thank you so much for your time and perspective today. It has been a pleasure speaking to you. Well, that's all from me for just now, but catch up with the latest FOMC news in another exclusive interview with my colleague, Dur McDermott. Goodbye for now.